In March 2022, two brothers checked their investment accounts on the same Sunday morning. Same family, same income, same amount invested, same 3 years. One was down $4,700. The other was up $22,000. Nothing about their starting point was different. The only difference was four specific assets that most investors have never been told about. Assets that have done the same thing in every major crisis for the past 100 years. And by the time this video ends, you will understand exactly what they are, how they work, and why the people who should be telling you about them never do. Most financial content treats market crashes like random disasters. Unpredictable, unavoidable, equal opportunity destroyers. But that is not what the data shows. The data shows something far more useful. Every major collapse in history follows the same three phases. Phase 1 is the crash itself. Stocks fall, credit freezes, confidence disappears. The S&P 500 lost 89% in the Great Depression. It lost 57% in 2008. It dropped 34% in just 23 trading days in March 2020. If you had $150,000 saved in a standard portfolio during 2008, you were looking at somewhere between $80,000 and $90,000 before the recovery even started. Phase 2 is the quiet one. Large institutional investors, pension funds, sovereign wealth funds, the people managing hundreds of billions, cannot sit in cash. So they move into assets with three specific characteristics: physical scarcity, essential utility, and a documented history of surviving every previous collapse. Phase 3 is where the wealth transfers. While the majority panic sells at the bottom, informed investors accumulate these assets at discounted prices. By the time the recovery comes, they have not just recovered, they have compounded from a lower base. The wealth does not disappear during a crash. It moves, and it always moves in the same direction. Here are the four assets, not theory, documented history with hard numbers. The first is gold mining companies, not physical gold bars, the businesses that extract it from the ground. During the Great Depression, from 1929 to 1933, while the broader market lost nearly 90% of its value, one of America's largest gold producers at the time gained 474%. A comparable Canadian producer gained 558% over the same period. The entire banking system was failing. Unemployment was at 25%. These companies were multiplying. The mechanism is simple. When confidence in paper currency collapses, demand for gold surges, but the cost of mining stays relatively fixed. Profit margins expand dramatically, and because mining stocks give leverage to the gold price. When gold moves 50%, the stocks often move 150% or more. During 2008, a widely tracked gold miners index gained over 200% from the market bottom to the peak in late 2011. Now, I want to be honest with you because most content skips this. Those same stocks fell over 80% between 2011 and 2015. These are not buy and hold forever positions. They are crisis assets. You accumulate them when nobody wants them, and you have a clear exit strategy. Fewer than 1.3% of U.S. investors currently hold gold mining stocks. That is not an accident. Wall Street makes no money selling you miners. It makes money keeping you in managed funds, charging annual fees. That is just business, but it is worth understanding. The second asset is long-term government bonds. I know bonds sound like the least exciting thing in investing, but the math during a crisis is remarkable. During the 2008 financial crisis, while stocks were losing 57%, long-term Treasury bonds returned 14.3%. In November 2008, alone, a single month, while equities were in free fall, long-term Treasuries gained nearly 15%. The reason is flight to quality. When crisis hits, large institutions need to move capital somewhere considered safe. Demand for government bonds surges. Prices rise. Anyone who already holds those bonds sees significant appreciation. The word already is everything here. The gains happen before the crisis becomes obvious. By the time it is front page news, the positioning window has usually closed. I also want to be transparent. In 2022, long-term treasuries had their worst year in modern history, down over 30% because of inflation. Bonds are a deflation hedge. When inflation accelerates faster than expected, bonds suffer. This is precisely why you need multiple crisis assets working together, not just one. The third asset is farmland. This is the one that surprises people most. During the 2008 recession, while the S&P 500 was down 57%, U.S. farmland delivered a positive return. Between 2000 and 2020, farmland returned an average of 11.5% annually with lower volatility than stocks. The logic is straightforward. Productive farmland is finite. Urbanization and climate change are shrinking it. Global population is growing. Everyone needs food regardless of what the economy is doing. And unlike gold, farmland generates cash flow through crop yields even when land values are flat. You do not need to buy hundreds of acres to access this asset class. Publicly traded farmland companies allow you to buy exposure for less than $20 per share with no special qualifications required. You get the same asset class that some of the world's wealthiest individuals have been quietly accumulating, broken into shares you can buy from your phone. The fourth asset is consumer staples companies, the businesses that make products people buy regardless of the economy. Toothpaste, groceries, cleaning products, coffee, the things nobody stops buying just because markets are falling. During the 2007 to 2009 crash, while the S&P 500 lost 57%, consumer staples as a sector declined only 28% and recovered significantly faster. Certain individual companies within the sector actually gained value during the crisis. The math on this matters more than it sounds. If you are down 57%, you need a 132% gain just to return to where you started. If you are only down 28%, you need a 39% gain to recover. Recovering faster means compounding sooner. That gap compounds dramatically over a decade. Wall Street analysts dismiss consumer staples during bull markets as too boring, not enough growth. But that is exactly why they outperform during crisis. Boring is a feature, not a flaw, when everything else is collapsing. Now here is where this becomes directly relevant to you. If you have a retirement account, a brokerage account, or any savings invested in markets, you are almost certainly heavily concentrated in assets that get destroyed during crisis. The standard advice, buy index funds and hold forever, works beautifully during a 40-year bull market. It works poorly during the 18 to 24-month windows when markets collapse 50% or more. And those windows have happened repeatedly throughout history. They will happen again. The question is not whether you will face one. The question is whether you will be positioned like the brother who was up $22,000 or the brother who was down $4,700 when it arrives. There are three signals worth monitoring. First, the yield curve. When short-term interest rates rise above long-term rates, that inversion has preceded every modern recession. The recession itself typically follows after the curve normalizes, within 12 to 18 months of that shift. Second, credit spreads. When the gap between what corporations pay to borrow versus what governments pay starts widening sharply, that is risk being repriced in real time. Third, unemployment. When the rate begins rising from cycle lows, even by small amounts, that historically signals the recession has already begun. The Federal Reserve responds to unemployment, which means they're always reacting, never leading. When two or three of these signals move together, your crisis positioning should already be in place. The brothers in this story had the same grandfather. He had lived through the Great Depression. He had watched certain families lose everything while others quietly built generational wealth from the same period of collapse. He spent years trying to pass that pattern on. One grandson listened, one did not, until that Sunday morning in 2022 showed him the cost of the playbook he had been given versus the one he had been missing. You now have both playbooks. If this changed how you think about the way your money is currently positioned, share this with one person who needs to hear it. A friend who has been doing everything right and still losing ground. A family member who thinks a single index fund strategy covers all conditions. Someone who deserves to know the second half of the game exists. And wherever you are watching from right now, drop your country in the comments. These patterns are not American, they are universal, and I want to know exactly where this is reaching.